In the world of small cap momentum trading, not every breakout is created equal. Some stocks launch like rockets, and others collapse under their own hype. Today, we're diving into one of the most misunderstood but powerful multi-day setups, the 3-day surge, also known as the 3DS liquidity grab. The 3DS setup begins with Day 1, the supernova, a massive spike, often driven by news, chat room hype, or a low float. It grabs attention, creates liquidity, and traps short sellers. On Day 2, price held around the middle of that move. Volume dried up, and traders started positioning for the Day 3 squeeze. Then comes Day 3, the decision day. If the stock holds most of its Day 1 gains and volume expands, it can trigger a short squeeze that sends price surging again. But if the volume doesn't return, that third day can also be a trap, a liquidity grab before the dump. Alright, quick check. Let's make sure this pattern clicks. Day 1, the supernova. What's driving that first big spike? Think about it. News catalyst, chat room hype, or a tiny float that ignites momentum. It grabs liquidity and traps shorts. Remember, on day number 1, we want to see a huge, explosive supernova move. That is what gets everyone's attention. A large gap up and a huge surge in volume. Day 2, the pause. Now what happens here? Volume fades. Price goes sideways. The crowd gets bored. This is where the stock proves whether it's real strength or just noise. Ideally, we want to see consolidation on Day 2, with light volume. When price can't crack VWAP, shorts get trapped. They jumped in expecting a breakdown, but when price stalls instead, they're left sitting and waiting in their positions, waiting for a drop so they can take profits or for a reclaim of VWAP so that they can exit with their stop loss. Day 3, decision day. Here's your question. Does volume come back and confirm a squeeze, or does it disappear and reveal a trap? Remember, when volume fails to return, that squeeze setup often becomes a liquidity grab before the dump. To recap, on Day 1 we see a big gainer with a substantial catalyst like breaking news or a major press release. On Day 2, the move pauses and draws in short sellers expecting the run to fade. Then on Day 3, if volume returns and the stock breaks its prior highs, it often triggers a powerful short squeeze. This is one of my favorite setups because it's statistically high probability and the risk is easy to define using recent daily candles. For example, you can enter on a clean breakout and retest of Day 1 highs, confirmed by volume, and set your stop loss just below the breakout level or the prior day's low, depending on volatility. The key is to let volume confirm conviction, not emotion. When shorts are trapped and buyers step in together, that's when the third day surge becomes explosive. Everyone loves catching a short squeeze. It's fun, it's fast, and it feels great when it runs in your favor. But real skill comes from spotting when that squeeze is done. Here are the signs a third day surge is losing steam and starting to break down. Here's how to spot when the 3DS is starting to fail. Volume behavior. If volume on Day 3 doesn't exceed Day 2's by the first hour, that's your first red flag. Price structure. If the stock can't hold at least half of Day 1's range, it's losing momentum. Tape clues. Watch the level 2. If bids are refreshing lower and sellers keep hitting, you're seeing distribution, not accumulation. VOP test. When price rejects VOP repeatedly without reclaim, it's not coiling for a squeeze, it's bleeding out. As a trader, your goal is to anticipate the trap, not chase the dream. For long traders, avoid buying the Day 3 gap unless volume and pre-market structure confirm strength. For short traders, wait for confirmation. Let it fail VWAP, reclaim lower highs, and then attack the liquidity unwind with tight risk above VWAP or prior high. The best trades come when the crowd is trapped, and the failed 3DS gives you that perfect scenario when timed right. The 3DS pattern is one of the market's clearest stories. It shows you where emotion meets opportunity. On a successful 3DS, Momentum confirms through volume and strength. That's when discipline meets reward. But when volume fades and VWAP rejects, the story changes. It's no longer a breakout, it's a trap. The key is patience. Learn to wait for confirmation, not hope for continuation. Because the traders who win long term aren't the ones who chase every setup. They're the ones who know when to step aside. In the next lesson, we'll go deeper into how to spot trap traders in real time, using volume, VWAP, and intraday structure to confirm your edge. All right, I've got a free gift for you. Starting today, I want you to become a 3DS tracker. Every morning, scan for stocks that gapped up 30% or more on news with 3 to 5 times relative volume, and preferably a low float under 20 million shares. Once you find a few, don't rush to trade them, just track them. At the end of each day, check back and ask, did volume fade? Did it hold half of day one's move? Did shorts start piling in? Because when you see those clues line up, you're not guessing anymore. You're stalking your setup, just like a hunter waits patiently for the perfect shot. Sometimes the surge happens on day 3. Sometimes it's day 4. The point is, the story is unfolding, and you're learning to read it. This exercise trains your eye, your patience, and your confidence. It's the perfect high-conviction trade for beginners because it forces you to slow down, analyze structure, and understand price behavior. And to help you get started, I've made a free 3DS tracking worksheet, a simple template you can fill out daily to log potential setups. If you'd like a copy, or the short tutorial video I made that walks you through how to use it, just leave a comment below or message me directly and I'll send it to you personally. Remember, the best traders aren't chasing price, they're tracking opportunity. Your next big win might already be forming. You just have to watch for it. Trading isn't about downloading more indicators. It's about upgrading your decision-making. The truth is, most traders don't fail because they lack motivation. They fail because they don't have just-in-time coaching. The market moves fast, and when it does, you need someone who can help you make sense of it right then, not a week later. That's what mentorship does. It shortens the learning curve that took me years into months, and it gives you structure when emotions start taking over. If you're tired of guessing and you're ready to build the habits, process, and system that create consistent profitability, I built something for you. It's a free masterclass that breaks down how traders go from random wins to predictable performance, step by step. Inside, you'll learn the same frameworks I use, from charting and bias to execution psychology and journaling. Drop a comment that says mentor or message me directly and I'll send you the masterclass plus mentorship starter kit completely free. Because you don't need more noise. You need a guide, a process, and the right timing. And when those 3 come together, that's when you stop trading for survival and start trading for freedom.